everybody. My name is Natasha Phipps. I am the CEO of WealthShare REIT, and I'm joined this evening with Rodney Phipps and Michael DiPaolo from the WealthShare team. And we're going to be talking about raising capital. And this will also apply to investing passively as well, but we're going to focus on the raising capital side of things. To give you a little bit about kind of my background just in the last few years, not just with WealthShare, but even with our personal investments. I added up in the last about 3 years, I've raised about $10 million across all of our projects. And so it's brought a lot of experience by doing and a lot of learning in terms of what's acceptable out there, what things you need to be careful of, and also just lessons learned in terms of talking to, hundreds and hundreds of people in this space, in the capital raising space. So the point of tonight is if you are raising capital or you're looking to get into it, you will hopefully have some good takeaways, some good things to get started. And if you are also raising capital and maybe are having some struggles, maybe something in here will help as well. So that's what we're going to talk about here this evening. Before we do get into it, I am going to talk a little bit about WealthShare, just like as examples through what we are going to be talking about this evening. Anything we talk about here is not a solicitation for your investment. This is for educational purposes only. And if you do want to review our disclaimer, you can head to wealthshare.ca to review the entire disclaimer. So this is our team here at WealthShare. Myself, Natasha, Rodney is here this evening. Monique is not here with us. And we are the co-founders of WealthShare. We also have a board of trustees inside of the WealthShare team, which are not listed on this slide. But the group of us is really who kind of makes all the major decisions within the WealthShare Trust. Okay, so before you raise capital, I think this is something that I hear time and time again. I don't think people are spending enough time on. I don't think they're spending enough time necessarily on what to do before you get started in terms of structures or knowing what you're doing or really what you're offering is more what I mean. What are you offering and how are you offering it in terms of the structure of the deal, what you're looking for. And so we're going to spend a little bit of time on that. But often even you'll see people go, well, I'm raising because I want to get into multifamily. But it's very general and very broad, or I want to get into storage, or I want to get into whatever it is. And I think you need to be more dialed in than that to really attract serious investors who are interested in what you're doing. Doesn't necessarily mean you have to have a property under contract, but you could find an example property, put together an example plan of what you intend to do with this, and then also have an example in terms of the rough amount of capital you are looking to raise, and then also what the offering you are offering to the individual you are raising capital from. Are you looking for partners? Are you, bringing in shareholders? What are you doing? And I'm going to talk about that more. But getting really clear on why and what you're doing and how much you need is really, really important. Many of you may know my job as well has been an investment specialist realtor here in Calgary. And so I've helped a lot of people buy a lot of real estate. And one thing, especially in the multifamily space, is people will come to me looking to buy real estate and they, aren't dialed into what it actually takes to acquire the real estate. So the, how much guarantor you need, for example, to qualify for the loan. So these are elements you need to be thinking of before you go out in the world. Guarantors or guarantee elements of a loan are often looked over, and you might even see on Facebook, especially these days, looking for guarantor help. There's people who have the assets under contract, they've removed conditions, they are ready, they need to close, but they don't have enough net worth to close the deal. So just because you have the money does not mean that is enough for the lender. So knowing what the requirements might be of the type of loan you are looking for is another thing to consider when you're out there looking for potential partners out in this space. So I'm a big believer in starting small as well. You only get one reputation. You only get one, first crack at this. And I believe starting small is the way to go. don't bite off more than you can chew. Some of the first projects I ever did was a single home, a single condo. We did renovations from there. Then we built infills. Now we have the WellShare portfolio behind us, but we didn't just start and run directly into this space. So we started very small, and I do think that is important because you will learn along the way. You will also get better with your systems and maybe how you do things if you start small and go for those wins. I know the big dollars and the big returns seem to be attractive, but if things don't go your way and you bite off more than you can chew and you don't have the experience, that will definitely come to kind of bite you later. So start small, get those wins, build up your reputation and your experience in this space. Okay, talking about structures, I just want to see if no, okay. Talking about structures. So this should be figured out before you find the real estate, in my opinion, as well. Because the last thing you want to do is if you want to, raise capital, whether it's just finding a partner, is you don't want to go get a property under contract and then you have, you have a month of conditions, you have a week of conditions, you have whatever time you have, and you're spending all of that on figuring out what the corporate structure is. You're figuring out who your partners are, where the money's coming from, instead of really spending that time on the due diligence of the property, which is what that time is spent for. And I do think this is a common way to get into this. And it does create a lot of stress for everyone, and a lot of mistakes happen during that time. So do your homework on the structures ahead of time before you even start going down this road. And I'll just talk about kind of a few of the most common. If you're just getting started in this raising capital space, I personally believe the best place to start is with joint ventures. I think it is a fair split between two partners bringing, something both to the table, and they both, generally speaking, in a joint venture, have a piece of the pie as well. So they have a piece of the equity or the ownership of the property. And so joint ventures, going back 5+ years ago, that was all that was talked about, was joint ventures. This is how you get into real estate. There was no OPM. There was no, private lending, promissory notes, like were very rarely a thing, but not nearly what they become. And I think there is, something to be learned from that what was fair during that time is what we got away from. And that was really what the real estate was behind it. So joint ventures are the simplest way. It could just be two individuals. You don't need to go set up a new corporate entity. It could just be two names that are going to buy this piece of property together. And ideally, you have a joint venture agreement that is going to outline what each of these parties are going to do, and what the responsibilities are for each person. This is the most simplest way to do it. You can have a lawyer drop a joint venture contract for, relatively affordable fees. We're talking maybe a couple $1,000 at most, if not, under $1,000. Ideally, you have all that sorted out, but I would like to see joint ventures kind of come back to the forefront here in the next couple of years, given all the volatility we have seen in the last few years when it comes to the promissory note world, which I'm going to talk about a little bit as well. But joint ventures are a very simple way. It's not complicated. Each person can be on the contract, on the title even, and there's working partners and financial partners. Oftentimes, the equity is split 50-50, but I've seen this done in many different splits depending who's bringing what to the table. So there's no like you must do it this way. It really can, you could equally share the work, you could equally share the money, however you kind of want to do it. So joint ventures, if you want to see an example joint venture example, I actually have another webinar that I did showing an example of one of our joint ventures where I actually went through the dollars and cents of it, went through how we did it and how we found the people and everything about the deal. So it was very lucrative for both parties and a really good example of what you can do with joint ventures. So happy to share that if that's of interest. Other common structures are corporations. Oh, also joint ventures, you can also use corporate entities as well. Two different corporations can partner together. That's a question that came up a lot a couple weeks ago when I did this talk in Saskatoon. So you can use corporate entities for that as well, or an individual and a corporate entity, doesn't matter. That's fine too. Other structures are corporations and GPLPs. Those are the two sort of common things, we've seen out in the last couple of years. So corporations, as well as the corporation, it can issue shares. It can issue shares to each shareholder. I see people using this most when there's maybe like less than 5 people. Again, I'm not a lawyer. I'm not here giving you legal advice, but it's kind of like a smaller group of people getting together. Maybe it's a little bit larger asset, like, a 5 to 10 unit building or something along those lines, has been where I have commonly seen the kind of small corporate structure make sense. But you can also look to a limited partnership, which is kind of moving up now from there. And one thing to note is the more, of course, you move up in the complexity of this, the more the fees will go up in terms of corporate fees, the setup fees, legal fees, accounting fees, all the fees just really start going up. So you don't want more than you need, really, right? But the limited partnership is just in real basic form. There is the limited partners and the general partner. And let's just say I've found an asset I want to acquire and I want to be the general partner. What that means is I'm going to go find limited partners who are going to invest X amount of money, and their investment is, or their risk is limited to the amount that they are investing. So that's a good thing for them. I, as the general partner, often the general partner's in control of the project. They're making decisions, they're in control of how things go, but they carry all of the liability for the entire project as well. So that's what, there is a trade-off there. And then even in the general partner, limited partner space, depending how the limited partnership agreement is set out, the equity component could be 50-50 with the general partner or limited partners. It could be 90-10, it could be 60-40, it could be all over the place. So if you're investing in this or you're raising capital this way, reading the limited partnership agreement is step one. And if you're going to raise money this way, developing your limited partnership agreement is step one. And you're going to want to do that with your lawyer. And then from there, you will be raising capital by issuing what's called limited partnership units. There's a subscription agreement that your investors would sign, and they go through the process that way. So as you can see, it gets more complicated, but what the limited partnership structure does allow for is you can have under 50 investors inside of a limited partnership in Canada, as far as I know. Don't quote me, I'm not a lawyer, but that's what we have been told. And so that allows for very different things. Now, one big thing where I'm going to start making my suitability claim here is limited partnerships. You're raising capital, you're raising this private capital, is supposed to be reserved for accredited investors only. The first acquisition we did with WealthShare was actually under just a limited partnership model at first, until we decided we wanted to evolve things to what WealthShare is today. And one of the huge limitations of just having a basic limited partnership for a development or for a buy and hold is, to be compliant with the Securities Commission of Canada, you should be only issuing units to friends or family or business associates or accredited investors only. And that is on you as the person raising the money to ensure and to ask those questions. So you are required to make sure you understand what that means, and to be, putting that in writing, asking these questions. So there does come a level of responsibility on you that you need to understand. And then from there, beyond the limited partnerships, which has now become sort of the new trend, is mutual fund trusts, or MFTs, which is what WealthShare is as well, and allows for a whole lot more things in terms of, you can accept registered funds. If you use an offering memorandum, you can actually accept investment from non-accredited investors or eligible investors. So as you can see, the more complicated the structure, the bigger the funnel gets in terms of who you can attract, but so does the level of responsibility upon you, and the level of understanding and level of compliance you must have. The more complicated, the more the oversight grows. So making sure you're not biting off more than you can chew is really, really important. And when you get to the, REIT level, you're required to do annual financial audits, for example. That is a massive expense and a huge job that I think is hard to comprehend until you've been through it, in my opinion. So think about what you're really trying to do here. Are you trying to, have a, small residential, portfolio of 5 or 6 houses? You do not need a REIT. You do not need a limited partnership. If I was doing that, I would just have 5 or 6 JVs. Just keep it simple, start small, and it can work really well. I mean, there's people who have done hundreds of these things. So make sure you're kind of matching your strategy with what you're trying to do to the structure. And get advice. There's no way to get into this without spending money. I can't tell you how often people tell me, well, I don't want to go down that road. I don't know if I want to do this. You need the advice to know if you even want to do it. I believe. So, and you'll learn something. I promise you, you will learn something from these specialists, your accountant and lawyer. They're there to educate you in this space. So get advice, pay for good advice. Do not shortcut on advice, point blank. Last kind of point here is, what is the market looking for? I think this is important too, right? You kind of want to have some thought and consideration of your network and who you're planning to go to speak to. What is important to them? And maybe that's a good place to start, is having a bit of conversation. What are people looking for that you know? Or do they really want the equity? Do they really want cash flow? What's important to them? And if you're designing a joint venture, if I know, these few people, it's really important they have equity, but they don't care so much about cash flow, that might identify a different type of property rather than if it was the inverse, right? And I can promise you, and another thing that constantly is a good reminder, is not assuming what people are looking for. Because I think often it's very hard to tell. We don't know other people's finances. Someone who's making at a high income level earning spot, they do not want more income, likely. They are trying to have growth. They want growth of their net worth and growth of their portfolio over time. So asking what's important to them is really important. And in a joint venture situation, maybe for you, cash flow is really important, like really, really important, like a must have. And in that situation, there could be even the idea of, okay, give the financial partner a little bit more equity and you take a little bit more of the cash component out of it. That could be an option. So having these kind of conversations. And the last one, really believing, is walking before you run.
Yeah, I was just going to, there's
Yeah.
a couple notes on there. First of all, the walk before you run, I think that's always important with any of these, anything that you're doing. And it ties back to all these kind of these strategies and these plans. But I just, a couple notes on some of the things that you said, like when, especially when you're talking about considering the structure and getting advice around those. Think of it from the investor's point of view. If you're not willing to spend a little bit of money and spend a little bit of the time and due diligence, having the right team, putting forward the right paperwork that protects everybody, why would they feel confident in what you're proposing, right? If you're not willing to spend even just a little bit of money or time and prepare something that fits the deal, well, you're already starting on your back foot, right?
Yeah.
You haven't think of it, if it was you and you were being presented something, would you feel confident if someone kind of came in willy-nilly and was, well, I got this great idea and I got a thing, but I don't really have anything on paper, and I'm not really prepared to spend the money on it just yet because I want to gauge interest. Well, it just automatically puts you on your back foot.
Yeah.
And so that bit of preparedness, it starts with, it shows confidence in what you're doing. It shows confidence in what you're offering. And it's something you would likely want to see from something yourself. And whatever the structure is, whether it's a joint venture, whether it's a GP-LP structure, even down to prom note lending, which we'll talk about later, and we have opinions on, of course. Make sure that there's a detailed explanation of what's going in, what everybody's responsible for. Really lay it out in advance. It's sort of that, you hope for sun, but you plan for rain. That's not a dig on anybody. It's something that we've learned sometimes the hard way. It's you want everything to go right, and you're going to expect
Yeah.
everything to go right, but lay it out in advance so there's zero surprises, so there's zero missed expectations, so everybody knows. Additional, there's no there, you'll never have a problem providing too much clarity.
Mhm.
I've never seen a situation where someone went afoul because they were just too clear about what everything and everyone was doing. And so those things kind of fold within some of these notes, that just add to, what you said at the end. What is the market looking for? Well, what would you look for if you were
Mhm.
going and someone was offering and you were prepared to write a check from your hard-earned money? This is people's hard-earned money. This is savings. This is retirements. This is future. If
Yeah.
you were prepared to risk your future on an investment, what would you want to see? So is it, what are those pieces? Start there and then work backwards. Because if you can't believe in what you're doing, if you don't understand it, if you don't really fully, truly have put through the work in every step of the way, how can you consider someone willing to do the same backwards, right? Like, it just doesn't really make sense. So you go through that whole process. Like you said, you'll learn something by spending a little bit of money on a lawyer. Make sure you have a great lawyer. See how get advice on people that have used good lawyers. Not all lawyers are created equal. Not all accountants are created equal. So you build
Mhm.
that team, then you're much more confident when you're going into whatever your project is, because you've spent a little bit of money, you've understood the risk, you've understood the structure, you've put the right structure to the right project to the right deal. And this is investment, real estate investing, but it's no different if it's the market or if it's something else. These things are considered. Working in the startup, it's the same thing. Who's the team? What's the paperwork look like? What happens when things go sideways? What's the expectation? Are you the first round of investment? Are you the second round? Well, the first round's probably got a bit of a different deal than the second round. And why is that? There's all these kind of these sections. And just because we're investing in real estate doesn't mean that should be taken away. In fact, it because this is a secured asset, it should be just that much more clear.
Mhm. Yeah. 100%. And if you are not aware of kind of what's been going on in the, you know, private lending world, I'm going to review that quickly, because this is what we're going to talk about as well. So part of why we're having this conversation and part of why we want to really have this conversation is there's been a lot of bad news in this space. And if you are going to be raising capital, I promise you it is going to come up. And it should. We should be talking about it, and investors should be asking you what you're going to be doing differently. There's risk always. You cannot remove all risk. That's just not possible. But if you're not aware, in the last few years, there has been several $100 million lost, at least just from the projects I know of, in the Canadian space of investors investing in promissory notes into like all kinds of different projects. Often they were land development or condo developments or the higher risk strategies where there wasn't necessarily any assets in place or bare land that's going to get assembled with something else. And to go to Rodney's point, what was shocking to me and the investors I've spoke to about this that invested and really got taken for a ride in some cases is it wasn't thought about if you're lending to a project that has zero income, where is the like interest payments coming from? Because why investors like promissory notes typically is because they are borrowing from their lines of credit and they're lending it out, which in nature isn't necessarily a terrible thing. You can use your line of credit, and there's all kinds of tax, benefits to doing that to invest in things. However, they were so because they're taking the funds out of a line of credit, they're incurring monthly interest costs, of course. And so capital raisers were saying, okay, we will borrow that money. We will, take it on a promissory note, and we're going to give you X amount of interest. And typically the numbers were very high. I'm talking 15, 18. I even saw 22% at one point at the height of this. And that was very scary out in the marketplace. We're super conservative in this space. But the worst part about the promissory note thing is there is no security for the investor. Um, and you know, if a project goes overboard or over time, that you will not, like, at some point paying those interest fees are going to sink you. And so that is what I think we can do better. I don't see a lot of space or reason to ever use a promissory note unless it's like, something, really short term and close by, and you really understand the risks. And I don't think people who are shelling out, millions of dollars were necessarily considering that, because there's a lot of trust between these parties. So this is going to come up if you are raising capital. The people will ask you about this. They'll go, "What do you think about what happened here?" So I think it's worth, if you don't know about it, spend some time researching it. There's all kinds of stuff online. And then go, how can we do better? And because that's what you're going to find out there. And that goes into kind of the key concepts here I want to talk about and how we can do better. So the first one there is talking about alignment of opportunity. And actually, one thing I want to mention before I do that, the promissory note lending space, if you are going to do it, you must, in my opinion, and I'm sure the Securities Commission would agree, that it should be only for accredited investors. The saddest part of the stories I heard, I heard this happening with students, with retired people who, put all of their life savings in these super high risk investments that were not accredited level in terms of their net worth or their income. So if you don't know what accredited investor means, give it a quick Google, but it relates to a person's net worth or their income. And really, it's their capacity to recover should something happen. And someone who's shelling out, all their cash resources and savings and investments, and it disappearing is a massive event. And so it's our job as people raising money in this space to understand this and take it very seriously. And I believe the Securities Commissions in every province has very much wind of this, and they are watching what we are doing, and it's only going to get more and more strict, as it should, in my opinion. So,
Yeah, just to add to that,
yeah,
is the securities laws are securities laws regardless. It's not like all of a sudden because you're in a back alley giving someone cash, the security laws don't exist.
right.
Sure, there's technically a gray area that exists there, but it's still governed by security laws of Canada. So you should be taking that approach when you're talking to somebody, and you should understand what the securities laws are. If you're, once again, you're dealing with people's future, their retirement, their families. This is serious stuff, and it should be treated seriously. And unfortunately, prom notes got really overused because they were able to kind of creep into that gray area, like you're saying, right? And just because it's a gray area doesn't mean it's not being watched, and that doesn't mean that private securities laws don't apply. And generally speaking, prom notes are for, within companies, if you're lending your company some money, or friends and family that you know very well on a short-term basis to pull off a project or do something. It's not meant to raise millions of dollars to build
Hundreds.
out hundreds of millions of dollars in some cases.
Yeah.
But it's easy. And just remember, if something's easy, why? Like, that's a good question to ask. It's really
Mhm.
easy to write a check that was that hard for you to earn.
Mhm.
It's
Yeah.
probably something worth thinking about.
Yeah. Well, and I think what it does show is that investors they like investing in real estate. They want to invest in real estate, but what they forgot about in all of that was the most important component of real estate, which is the real estate. And real estate, like, why we invest in real estate is because the building or the asset or whatever it is your security. That is your security blanket. It is what's going to catch you if you fall, if you do it right. And in a lot of and in all of these cases, almost often they weren't secured against anything else. So it wasn't like they were secured against other assets. So think about that from the investor standpoint: is you want to offer them security. You want to be doing the right thing. So how are you offering them security?
Yeah, and I will try my best to stay off of that soapbox that I get
I
onto,
know.
because that's one that's I'm very passionate about, because I've been involved in startup communities, in tech, in high risk things like the restaurant business, music business. These other areas that are higher risk have different risk profiles, but also different potential returns. So even energy sector, like there's all these different structures and all these different investments, and they're all great in their own way, but they
Mhm.
come with really high risk. And part of the reason why is because they don't have that secured asset behind them. So going to real estate was always, and it's always been, that backbone part of both of our investment strategies. And it's allowed me to take higher risk things, but it was because the security was there. So when I, came to this space, started looking at what was going around, going, well, what the heck's going on? People are investing in real estate, but giving away the security. What? Just stick with Bitcoin or penny stocks or whatever it might be, because you're giving away your edge. Yes, the returns, you can't compare returns from a development to a buy and hold. You can't compare the returns of real estate to Bitcoin because they're completely different things and they come
Yeah.
with completely different risks. But what real estate has that those other ones doesn't is the secured asset. So why
Yeah.
give it away?
Mhm. Agreed. Okay, so alignment of opportunity. So you are going to be facing this out in the marketplace. I do think, one good thing that is coming out of this is we're all remembering why why we like real estate. And it's your job to obviously discuss the benefits of real estate in terms of security you can offer. So, but that does need to align with the opportunity, obviously, with your investor. So things to consider when you're trying to figure out if what you're offering aligns with an investor. Certain things that I would certainly be talking about are timelines, um, their risk tolerance. Generally speaking, the more variables anything has, the more risk it has, right? So if an investor is comparing investing with you on a buy and hold, project, or considering investing in a land development project in somewhere, the development project is often more risky now, but has higher projected returns, as it should. So there's nothing wrong with either one of them, but typically you want to kind of, have slivers of all things, have some balance and diversification. So having those conversations with people and asking them what they want and is something that is the first thing that I do is I want to know what people are looking for, what they're already invested in, and align, the kind of opportunities I have. And there's nothing wrong with saying, you know what, that's just not where I'm going. This isn't aligning. If they really want the returns of a development project, you cannot promise that if you are doing buy and hold real estate. You just cannot. So, it's okay to say, you know what, this isn't the project or this isn't the one. And you've met someone new, maybe you've made a new relationship. So aligning opportunity is really, really critical.
And I just, sorry, I'm jumping
Yeah.
in a little bit here, but I also think that this one of the things, and obviously I'm a big fan of yours. That's no secret, but I think one of the things that's led to you being so successful at raising the amount of capital you have over the last while is that you do take that time to ask what that person wants. I guarantee you, most people when they're raising capital have no problem talking about why their thing is so great, but
Mhm.
very few people stop to go, well, what about what you're looking for? And
Right.
just taking that stance of going, hey, before I get into my pitch, before I go into what are you looking for? And on
Yeah.
top of that, it might save you some time and energy as well. And it likely will build trust, but it also just differentiates you from the market. There's no shortage of people out there raising money, and there
Yeah.
never will be. That's fine. That's great. There's passionate people with passionate projects, and that's important for business and growth. But one quick way to differentiate yourself is just by taking that minute to stop and go, what are you looking for? Like, what is
Mhm.
it that you want? And all of a sudden, you are a much smaller pool of people, and and it builds trust, and as it should, right? Because then you're actually considering if that person's investment is the right thing for what you're doing, which then goes back to security law. Just because you're not pretending you're not involved in security law doesn't mean you're not involved in security law, right? And that's what accreditation means. Is that the right investment for that right person?
Mhm. Absolutely. And that kind of goes into the last two things here is, all the kind of structures I mentioned. Obviously, we don't have time to go into them deep, but as soon as you're going above that kind of joint venture space, you are in this private securities world and you need to understand it. But I want to talk about private lending as well, because people also interchange the term passive investing with private lending as if they're the same thing. And it happens to us all the time. Our own investors do it. Um, Even though, so when you're passively investing in something, like you're buying a stock, you're, investing in WealthShare, you're investing in anything that you are not, in charge of, you're passively investing. That is a private security. Now, private lending is different because there is a debt component. In a private security, like your investment with WellShare is an is an equity investment. You're an equity holder in the WealthShare fund. It's not debt. It's not debt for us. Private lending should be considered as debt. And these are two different sides of the coin, the equity coin, the debt coin. And for some reason, everyone's just putting them all together like they're not. So you can private lend and still have security. You can do things like private mortgages. Private mortgages is a great way to tap into registered funds without having a REIT like we do. You can use registered funds to mortgage on a project. Now, it can't be your registered funds, and the funds have to be arm's length. Arm's length. So it can't be your immediate families or anything like that. But if you had a project, I could lend you my registered funds, secure them on the project as a private mortgage, and vice versa. It can't be like a swap like that. You're not allowed to swap registered funds. But if down the road there's another project, you already have this kind of experience, you can use it. So no swapping funds and no friends and family on this. It has to be arm's length, but you can do a private mortgage in either one of these spaces. So that's a great way to give your investors security if you do not want to give up any equity on the private security side, but maybe you are okay to have debt because this project doesn't have debt for some reason, whatever it might be. So thinking about them differently is important. And then when you go into the private lending space, then you're dealing with like mortgage law as well. So
Yeah.
which does vary by province. So really keeping that in mind. And we've already talked about this a lot, but to bear in mind with all these structures that you are being given and the kind of nervousness in the marketplace, the first question I'm getting asked right now is, do you offer security? Is there security? And I can tell you a year ago, that wasn't the case. A year ago, it was, Natasha, this is too much paperwork. Can I just send you a check? And I would be like, no, you cannot just send me a check. I don't want a check. I want you to read this document and look it through. And so, and that's not really, it's for all of our benefits, but it's really for their benefit. So whatever structure you're looking at or whatever, amount of capital you're raising, you need to be able to answer this question. Are you offering security and what is it? So keep that in mind. So we kind of touched on this, but suitability, I'm going to talk a little bit more like specifically about what it is and why it's important. So suitability is something that not a lot of people understand that is defined already for us. It is not my opinion or your opinion. The suitability component in when you're raising capital is determined already for us. And there is kind of three kind of buckets to consider. There's your accredited investors, which have that significantly higher net worth, higher income. There's eligible investors, which I would probably put more on the kind of like average Canadian or close to. And then there's also friends and family. And to really be doing your job well as a capital raiser, you do need to understand these things. Now, when you get to the point of having a fund or something like what we're doing with WealthShare, we actually have other people ensure suitability for our investors because that removes a layer in terms of course, we want, our project to move forward. But the exempt market dealers out there, their job is actually to protect the investor and to ensure suitability for an investor. So if you're working with any groups like us, that is why, and it is actually required that we use an EMD or exempt market dealer. So their job is to ensure suitability, to ensure we are compliant. But as you go down to the more private space, there is no exempt market dealer often. And so the person raising the capital is the person who is responsible in this case. So understanding that really, really important. And just do a quick Google search. And if you are doing some higher risk, you decide to go down that road and do a promissory note or something like that, just stick to accredited investors. And there's also an accredited investor form that they would sign to say that they are accredited. That means you did your job, you asked if they were accredited, they signed this document to say, yes, I am accredited. And that is really what's going to protect you should something go sideways. So if you don't know, talk to your lawyer about that. They can help you with that. There is an instrument, out there that they can provide you to use with your investors should you really want to go down that road.
Yeah, and just like you said, this is, once again, securities law determined. This is not our opinion. This is not our thoughts. It is dictated by securities law of Canada. And in effect, it is what people can afford to lose. It is not an award or a badge that you get.
Mhm.
It is Securities Canada law has determined that people that fall under accredited status likely can lose their investment and still be okay. And so higher risk investments that are accredited only generally fall on that because their risk profile is higher because they have a bigger safety net. So if you understand why those things are there, that helps you also understand like why the request is there, what the requirement is around. And like we keep saying, and I'm a bit of a broken record now, but I think it's important, is it's still securities law. Just because it's in a prom note doesn't mean it's not governed by those same things. So it should still be an accredited risk because accredited investors technically have a higher risk profile.
Yeah. Okay, I want to move into kind of like how to present these investments, how to find, people that might be interested in what you're doing. Because that is something I get asked a lot about is how do you, I have a project or something I really want to do. How do I find the people, Natasha? How do I go find them? And, there really is no shortcut to this. The really like short and sweet answer of this takes time. You do need to build a network. You need to build relationships, not just for them, but also for you. I do not just want to work with just anyone. I want to work with people who we have a mutual relationship that makes sense, that we have similar values and similar goals and we get along. Like if you are doing a joint venture, for example, you're likely, agreeing to be sort of tied to these people for several years. So you want to get to know people. And so what I encourage you to do is to share what you're learning, even share what you're learning today. Let people know you learned a little bit about capital raising tonight with the WealthShare team. And if you ever want to talk about it, let me know. You have to step into this space of putting the energy out that this is what you want to do. There's no other way around it unless you already have a network full of people, that are willing to invest in you, which is the hard part. So you got to get out there. You got to get a little vulnerable. You got to put the energy out that this is what you're looking to do, and you'll be surprised because a lot of people are very interested in real estate. They love real estate, but here's the reality: is the rate of home ownership, the rate of real estate investing is just going down in this country. But that doesn't mean the interest isn't there. It's just maybe people need another way or a different path. So aligning, what people are looking for, we already talked about, but it could be just that an individual cannot do it on their own, and they need to partner for whatever reason. It could be for time, it could be for resources. I remember back in the day with REIN, when you'd go to REIN meetings, you would get a badge, whether you were a working partner, a financial partner, or I think there was a few other ones. And so you'd be walking around and it's like, okay, who's there to do what, right? Like I'm willing to put in the work. And the financial partners often used to be working partners. And they're like, you know what, I don't want to be working partners anymore. Now I'm a financial partner. So you'll move through different stages in life. But it's all about the relationships. So build the relationships, put yourself out there, tell people what you're doing, post things. You have to put yourself out there. There's just no way around it. And I can't marry people together. That's another thing. So, okay, we're going to talk about, okay, so in the joint venture example, let's use that because it's the most like basic entry level thing. In the example I gave, I had, been going to REIN meetings for years. I had been building my network. I'd been an investment specialist realtor for quite a long time. But doing that first joint venture definitely was a step. And it's really incredible to me what happens when you start putting out there in the world, believe what you want to believe, but you kind of have to put it out there to get something back, I believe. And I had been deciding, okay, this is what I want to do. And everything just started kind of falling together. So if I didn't have the network, like I had already had conversation with, if I find a deal, would you be interested if I call you? And I just have a few high level questions of what their budget might be, what they're looking for in strategy. So once you have all that, and then you find opportunity, then what do? How do you present these things? And if you do want to see an example of how I present things, I can send you that video that I did. But it doesn't need to be complicated either. You want to cover everything we talked about tonight, but you don't need to like write an essay or a huge book either. It needs to be simple. And an investor is not going to spend, 6 hours reading through an essay. They want a one-page summary of what you're doing. If they're interested, then they'll dive in more. So have a one-page summary that kind of covers the key points, all of these points here. So what is the deal? You know, is it a project? Is it a reno? Is it a flip? What is it? Where is it? How much money do you need? And kind of start giving the really key points. And ideally, you're presenting to people I said they already know you, but you might want to highlight who your team is as well in this little, document, because it could be, you and your trades or whoever else you have involved in this. And just make that really clean and clear. Like you've already decided, these things have been decided, you're on it. And it's very clearly understood what the structure is, what the timeline is, and what the exit plan is. And I find this works very well. Just a one page, this is what we're doing. And if you're interested, let me know. We'll send you some more information or have a call. So don't overthink this. I have seen 10-page pitch decks. I have seen, very, very detailed things that people have spent years on, and you would be surprised that mine is actually pretty simple. It's one page, it's quick and to the point, and I respect your time. So I find that works well. You might find otherwise, but I think, that respects everyone's time. Now, the last one too is encouraging questions and building trust. Point out the risks, and point out the variables, because especially when we first get into this space, it's very exciting. We really want to get these deals done. We really want to get this stuff done, and you will, but you want to build relationships built on trust. And it's kind of like, if you're ever home shopping, because I'm a realtor, I can say this, but realtors who are out there and they only ever point out the good thing in a home, like to me, I always say that's a red flag. I also point out, oh, there was a leak there at some point. Oh, looks like they did some addition here. I wonder if this was permitted. Like, things like that. You want to point out the good and the bad. So make sure you're doing that too. And there could be things you don't know yet. So identify that too. Like this will be figured out more during our due diligence phase while we have this property under contract, for example. So really encourage questions, build that trust, point out the good and the bad and what you don't know, and don't be afraid to point that out.
I think that's one of the biggest ones is being comfortable answering questions. We've encountered people that are uncomfortable answering questions, and I think that tells you everything you need to know. We've always welcomed difficult questions because if we don't have the answer, that means maybe we're not seeing something, or we need to learn more about something, and we need to go figure something out. And so if someone's not comfortable answering a question, what does that tell you? Either they're unable to answer because they're not aware of the answer and they're not really understanding their project, or they don't want to tell you the answer, which is an even worse situation. So be very comfortable answering questions, encourage questions, and ask the questions of your own project so that you're prepared. Everyone has a frequently asked question. We have them with WealthShare. There's a lot of the most 95% of the things we answer are questions we get all the time. So we're very comfortable answering them. 5% of the time, there may be different questions that aren't on those things, and that's great. And that allows us to get into the more detailed nuances of our structure. But know what those questions are beforehand, and then you're ready for them on the spot, and you're comfortable answering them, and you know your project.
And also, like, if you don't know the answer to something, don't fake it either.
Yes.
There's things I'm like, oh, I don't know. No one's ever asked me that before. And it's really a question for Monique, our CFO, or something like that, that I'm not an expert at, or I'm not comfortable asking. And that's okay. It's okay to say, I don't know. Let me get back to you on that. I'm going to find out. I'm going to go ask my team. I'll find out. That's okay. And you just write that down for next time. And I think, that scares people a little bit to get asked something they don't know. It is absolutely okay to get asked something you don't know. You want to try to expect what people are going to ask, but it's okay if you don't as well. The fact that you're even learning about this and you're out there reading books and learning and educating yourself is 98% more than what most people are doing. So you can own that you're kind of trying to become an expert in the space. You're putting in the time and energy and effort, and own that, but you're not gonna know everything.
Yeah, because guess what? As soon as you fake it, then you lost that person right there.
Yeah,
right?
they can tell.
They can tell right away.
Yeah. So we talked about a one pager. This is the WellShare one pager. Of course, I have to give WellShare a shout out here this evening into what we're doing. And then I'm going to talk about the last 5 minutes, just some quick kind of, lesson learns and top tips, and then we'll kind of wrap it up. But our WealthShare overview does tie in everything. Obviously, we talked about this evening, but I would have something like this for a joint venture as well. Quick, to the point, just this is what I'm doing, and then someone can decide real quick if it's for them or not. So they need to know, do I have the capital? So the first thing people often look at is what does it take to invest in WealthShare? So we have a low minimum investment of $5,000. So that removes that kind of right away that most people want to invest can invest at that point. What kind of funds does it need? The other thing you might want to have on an offer is if there's a deadline as well. So if there was a deadline, a timeline, or something like that, you must have, you're going to want that on that sheet too. So WealthShare is open to eligible and accredited investors. You can see how it says subject to compliance with applicable securities laws. That means our exempt market dealer is going to ensure that someone is actually eligible or accredited, that they meet one of those standards. Is it registered account eligible? Maybe you're okay to accept a private RRSP mortgage and someone might have capital sitting there ready to deploy. So, and then what is your targeted return? If you do not know how to calculate your returns on a project, this is the first place to start, is how do you find returns in real estate, and knowing what that might look like. So if you're not familiar with that, that'd be the first thing to start learning about. But just quickly, returns in real estate are made from cash flow, which is what most people think about, debt pay down, which is the most predictable part of long-term real estate holdings, the passive appreciation of the market, and any active improvements you make to a property. Those four things combined will give you your total return of a property. And yeah, so this is a little bit about what WealthShare is doing. We do have about just under 300 investors in the WealthShare umbrella and have acquired about $30 million of real estate in the last few years since we started. That's what the portfolio is worth today. So it's been a pretty exciting time. And I've learned a lot doing that, onboarding that many investors, and also through our personal sort of project as well. So just a few lessons learned that keep showing up for me all the time. And one is not on here, but I'm going to mention it. So first one is never assume how much money someone has, what their goals are, what they, what matters to them on a project. If they care about cash flow or not. I can't tell how many times people focus on cash flow. And yes, you want the project to cash flow, but the investor might not need the cash flow or even want the cash flow. So never assume what the priority is. Always, always ask. And I cannot tell you how many times this comes up for me that I'm like, oh, I'm really glad I didn't assume there. I'm really glad I didn't make an assumption. So really never assume. Always point out the risks like we talk about. And communication. I mean, everyone knows communication is important. One of the first lawyers we sat down with before WealthShare started, when we told them what we wanted to do, was like, no, you do not want 300 investors. That's what he said. He's like, you do not want 300 investors. Then you're going to have to talk to 300 investors. And we communicate a lot. We make ourselves very available. I think almost every investor, I think, has my personal cell phone number, and I'm okay with that. That's one benefit of investing with us. And what I want to point out about communication is, I hear people saying, this person asks too many questions, they're not good to work with, or they want updates too much. Like, you should be providing those things. And if your investors are asking you things and you are not providing the answers, like, that means you're not communicating enough, is where I'm kind of going with this. So if people are asking, that means you're not telling them enough. So very rarely do we actually ever have people reaching out asking how it's going, because we're constantly out there, we're constantly available, and they know what's going on. And if they don't, or if they have a question, we're here to answer it. And also communicate when things do not go right. Period.
Period.
Things don't go right all the time, and there's risk in this, and I think this is something people are very scared to do. It is uncomfortable, I understand that, but it builds trust, it builds credibility, and then you can talk about, okay, what's the solutions. So do not hide things that are happening. If you need to have regular meetings with your partners or whatever to update them on what went good, bad, and wrong. There's one investment I'm in, and once a month the owner of this company, this is a tech company, sends an email: good, this, bad, this, unknown this, and it's very short. He does not put any pleasantries in it. But I love this update. It's like not my style, but I love that I get it. I know what went good, I know what didn't, and that's it. So communicate, and that directly ties into your reputation. No one expects everything to go right all the time. I've had to say, listen, we didn't hit the mark we wanted. We didn't get the financing we wanted. CMHC changed policies, blah, blah, blah. There's all kinds of things that happen all the time. And it's not ideal. It's not what we hoped for, but people understand that. And so don't forget that people want you really, want you to win. They want to hear from you. So tell the good, the bad, and the I don't know yet if there's still things in the air. So, and that will lead into your, reputation. You're never going to have everything go right, but that doesn't mean you need to have a poor reputation. That comes down to the communication. So always, take that into consideration. And that's everything I have.
And my last one on reputation is like, it's a cliche, but it's a real one. It takes years and years and years to build up a reputation. And it can take one bad deal to lose it, right? And
Mhm.
then to rebuild it. And bad news spreads fast, right? People talk as they should. People should be informed about things going bad. So we've had to adjust working relationships for ourselves because of things like this. We have to be
Yeah.
aware of it. You have to watch. And it's so much quicker. It's like bad reviews for a restaurant. There's you can get 100 good reviews. You get one bad review, and that comes straight to the top. That's what people look for, right? So
Yeah.
your reputation is everything you got when you're out there raising capital, because it like said a few times, you're dealing with people's future, their hard-earned money. It's something that you should take seriously. If you're not taking it
Yeah.
seriously, that falls on your reputation.
Yeah, and I've just heard a lot of bad stories, and I've seen a lot of tears over Zoom calls in the last 2 years. That's heartbreaking. And these are people who I think would have understood at a lot of points. But the last thing that I didn't write on that last slide, which I need to add to it, is putting your investors first, no matter what. I think, there's certain things you can't avoid, but if there's anything you can do to put your investor first, especially if something goes wrong, will go a long way. And I understand, you need to, like, you're doing this to better yourself, but you do not want to put you above your investor. You come second. Just like if you own the company, you pay your staff first, you pay yourself last. It's the same kind of idea. Take care of your investors first. We have examples of things where we're not taking anything out of a project for a while because we want our investors to do well and hit the targets that we really wanted to achieve for them. So that doesn't mean that there's not things that go wrong or there's nothing in it for you, but really do what you can to put your investors first, and that will tie back into that positive thing in your reputation. It's not if everything goes perfectly, it's how you handled it. That's really what matters. And yeah, putting the investors first. I had one more thing, but I think that's all I can say to
Yeah,
that.
you'll see those things in the fine print in certain offerings and certain deals out there. Like there's some wild ones where the
True.
team's taking massive cash flow every month out of the raise, and you're going, what the heck? Like
Mhm.
that's not putting the investor first.
Mhm.
And if you were an investor, what would you want to see? And you should be putting the investor first because they're the one putting in the capital. That's the hardest part. Um,
Yeah.
and so they should be treated first. And yes, it's your future, and you're building this thing, and you want to be financially secure and all those things like you said. But if you're not putting the investors' money first, what would you be comfortable with that? Goes back to
Yeah.
what we keep
I wanted
saying.
to put it.
Why would
Yeah.
you why would you be comfortable investing in something where the person that is running the operation gets paid first?
Mhm.
It doesn't it just doesn't make sense intuitively. So it shouldn't on paper.
Yeah. Agreed. Oh, this
I
is
did
a
all
call.
right. I stayed off my soapbox for the most part. I did okay.
I think that's everything. We could talk a long time about this topic. We're very passionate about this. Things don't always go right. You do your best, but like have that integrity in terms of learning what you don't know in this space is really the message. If you're going out there to raise capital, learn these things, know them inside out and backwards, and protect yourself, and protect your investors. Really important. And then you can start from there. Start small, build up.
Yeah, and just the last note, unless I didn't see any questions, so you people in attendance or seeing this recording, you might hear from Michael in the coming days with just a follow-up chat. See if you have any further questions or thoughts, or if you want to learn more about WealthShare, anything at all. He's there to kind of be that sounding board, regardless. So if you see that pop up, that's what that's about, and we look forward to chatting with you further.
Awesome. Thank you.